Hi, everybody. This is Chris with Invest LYH, and I just wanted to go over a quick video on an article that I read recently. And I thought I'd share it here and let you guys know a little bit about the background of the mantra that we hear in real estate a lot: location, location, location. And um, I have it written up here, and we always talk about it, and we're like, okay, well, we kind of know that, but is there science behind it? And there is. And I kind of wanted to go through that really quickly. There's a paper out there, and it's called Do Conspicuous Consumers Pay Higher Housing Premiums? You can see the title of the article is right here. And within the article itself, what they do is they discuss that in fact, it does. There and what the way that they measure this is a little odd. And I'll kind of get in on that a little bit later. But for non-real estate examples, it talks about fashion brands down here that regularly increase their prices by 20 to 30% per year. And now this, you can see here that this was back in 2012. So it was during a boom cycle. And if you know economics, generally goes like this. So when you have that trough on the bottom and you have that upward economic activity, that's considered a boom cycle. So when we hit I think it was 2000, and I think it was like 10, right, is when the bottom hit. It may even have been 2009. So we would have been on the upswing in 2012 for this particular journal article writing. But the fact remains that this conspicuous consumption, which basically means that people they they like to show their wealth, right? So you'd rather have a bag with a coach on it than just a bag that is all leather. Um, some people do that, and in fact, it says right here that they can sell them for 20 to 30% more every year. So, and now here, the other thing that you have to consider is this aspect right here, focusing on middle age consumers from the ages of 40 and 60. So there is, and it says it here, for automobiles as a symbol of prestige and success to enhance their self-image. That is what the facts show. Now, how did they figure this out? Well, the way they did this, and this is how we do it in economics, we kind of run models, right? And there's a model out there that you can use, and what it's called difference in difference. Yeah, let me see. It doesn't necessarily say it in this snippet here, but that's what the DID stands for, difference in difference. So let me write that out. We used to call it diff and diff, right? And what that means is when you're measuring something out, right? You have a chart, you have one section, and you have an observation one, and you have another observation two, and then you have a corresponding chart in observation one or in observation three and an observation four. You measure these and you identify the difference, right, between the two. And now at this point, you change something and you see if this continues and if this changes. What you do is you take another observation, let's say call it 5 and 6, and you will estimate where this will go based on these two previous estimates, and you'll identify the estimate for here. And then you take the difference of this and this. And now you have the difference of difference, because here's the original difference in difference, I guess. And so what they do is this is how they're able to measure if this change is causal. And what happens is when they do that, they're able to identify that there's an actual cause and effect relationship between what happened here at the change and here at observation 6. So they did that for this study, and they identified using, I think they used a ton of data. And they used, I think they used 96 MSAs throughout the United States. So that is a lot of data. They went from Ohio, they went to Baton Rouge, they went to California, to New York, and they were able to identify and found out. This is actually in a later article in 2022, I believe, that cited this article. So this article by Lee and Mori is cited right here, and it shows that there is a positive relationship between the price disparity between high-end and medium houses across the United States metropolitan areas. Now, anytime you see positive relationship, you know that it means that if one goes in one direction, the outcome will go in one direction at some sort of multiple. And now if one goes in the other direction, again, it'll come in some sort of multiple. A positive is basically like a direct relationship, like if we do this, this will happen. And the reason why I included this here is because they were looking at this article from 2016 to show that there is that positive relationship. And this all comes back to, this basically is a scientific method of proving the old mantra, location, location, location. And why is it? Because people want to prove that they have wealth by not just what is in their bank account, but in what size of home they have. Now, how can this help as an investor? Well, if you know that an area is desirable because people are purchasing there, you can purchase there as well. And you will generally have a higher return on your investment based on the facts here. Now keep in mind, this was back in 2016, and I was reading through the article, and they had hundreds of thousands of dollars in difference between what they called it a premium. So if I was going to spend 200,000 on a home, I might pay a $100,000 premium to be in a better area or to have different features. So if you identify these areas, right, where the home has these premium features that they're looking at, then it will help your portfolio grow. Just thought it was an interesting article that I wanted to share with you guys. So if you have any questions, please let me know, and we'll talk at some point soon, guys. Thanks.